What will happen to the US dollar in the coming years? This question matters more than most people realize. The dollar is not just the currency of the United States. It is the backbone of global trade, global finance, international debt, and global reserves. When the dollar changes direction, the impact spreads across countries, markets, and households around the world. But before we talk about the future, we need to understand something fundamental. The dollar is not powerful because it is perfect. It is powerful because people trust it, use it, and depend on it. Money itself is based on trust. A dollar bill only has value because people believe others will accept it. And on a global scale, the US dollar became dominant because it was stable enough, liquid enough, and widely accepted enough. After World War II, the United States became the strongest economy in the world. Europe and Japan were rebuilding, while the US had strong industry, strong exports, and strong financial institutions. Because of this, the dollar became the center of the international monetary system. Under the Bretton Woods system, many countries pegged their currencies to the dollar, and the dollar itself was linked to gold. This gave the dollar global legitimacy. Even after the US ended the gold standard in 1971, the world kept using dollars. Not because it was perfect, but because it was already embedded into trade, banking, and reserves. This created a powerful habit. Oil is priced in dollars. International contracts are settled in dollars. Global debt is issued in dollars. Central banks store dollars. So even if another currency wanted to replace it, switching would be extremely complex. Now let's talk about how the dollar behaves over time. The dollar does not move randomly. It reacts to confidence, inflation, interest rates, economic strength, global risk, and political stability. Every major rise or fall in the dollar has historically followed a clear story. One important pattern is that the dollar often becomes stronger during global crises. This might seem strange. You might expect the dollar to weaken when problems start in the United States. But in reality, during crises, global investors rush toward the dollar because they need liquidity and safety. In 2008, during the global financial crisis, banks collapsed, markets crashed, and fear spread worldwide. Instead of collapsing, the dollar strengthened. Why? Because global debt is denominated in dollars, and institutions needed dollars to pay obligations. The same thing happened in 2020 during the COVID crisis. Economies froze, trade slowed, and financial markets panicked. Demand for dollars surged. The Federal Reserve had to provide emergency dollar liquidity to other countries through swap lines, simply because there weren't enough dollars in circulation. This shows an important truth. The dollar benefits from global fear, not because it is flawless, but because it is still the most used and trusted system. If by 2026 or later the world remains unstable, facing wars, geopolitical conflicts, debt stress, or financial shocks, the dollar could remain strong or even strengthen further. In that scenario, investors choose the dollar not because they love it, but because alternatives look riskier. But a strong dollar creates problems. When the dollar becomes too strong, US exports become more expensive, hurting American manufacturers. Developing countries that borrowed in dollars struggle to repay their debt because their local currencies weaken. Global financial conditions tighten, making borrowing harder worldwide. We've seen this before. In the early 1980s, US interest rates were raised very high to fight inflation. The dollar surged dramatically. But this caused severe debt crises in Latin America and other emerging markets. Eventually, global policymakers intervened in 1985 through the Plaza Accord to weaken the dollar. This teaches us a key lesson. Extreme dollar strength often leads to instability, and policymakers tend to resist it. Now let's explore a second possible future: a slowly weakening dollar. This does not mean collapse. It means gradual loss of purchasing power over time. A powerful historical example is the 1970s. After the US left the gold standard, inflation rose sharply. Prices increased faster than wages. The dollar didn't disappear, but it bought less every year. People felt poorer even if their income increased. This is how currencies usually lose value. Not through dramatic crashes, but through slow erosion. If in the coming years, inflation remains structurally higher than expected, and wages fail to keep up with rising living costs, the dollar could continue losing purchasing power. This wouldn't necessarily show up as a dramatic chart collapse. Instead, it would appear as everyday frustration. Groceries cost more, rent rises, savings feel weaker. This kind of decline is subtle, but historically common. Now let's talk about interest rates, explained simply. Interest rates are like rent for money. When interest rates are high, investors earn more by holding dollars, so demand for dollars increases. When rates are low, investors look for better returns elsewhere, which can weaken the dollar. In the early 1980s, extremely high interest rates strengthened the dollar dramatically. In the mid-2000s, lower interest rates contributed to dollar weakness. If in the future the US keeps interest rates higher than other major economies, the dollar could stay supported. If rates are cut aggressively while other countries maintain higher yields, the dollar could face downward pressure. Another key factor is government debt. The United States carries a large amount of debt. But debt alone does not destroy a currency. What matters is trust. Japan, for example, has very high debt, but still maintains a strong currency. Currencies fail not because of debt levels alone, but because confidence in repayment weakens. As long as global investors believe the US can manage its debt without runaway inflation, the dollar can remain stable. But if confidence shifts, even slightly, it could lead to gradual weakening. Now let's talk about global diversification away from the dollar. Some countries have been slowly trying to reduce reliance on the dollar in trade and reserves. This does not mean replacing the dollar overnight. It means small shifts, using other currencies in trade agreements, increasing gold holdings, or settling bilateral trade without dollars. History shows that reserve currencies decline slowly. The British pound dominated global finance for more than a century. It didn't collapse suddenly. It gradually lost influence as Britain's economic power faded. If the world continues diversifying, demand for dollars could slowly decline. This wouldn't destroy the dollar. It would reduce its unique privilege over time. Technology also plays a role. Digital payment systems, central bank digital currencies, and financial infrastructure are evolving. If the US leads in these systems, the dollar could remain dominant. If it falls behind, alternatives could gain traction. But again, change tends to be slow, not sudden. Another important force is psychology. Money is belief. The dollar has power because people believe it has power. As long as individuals, companies, and governments trust it, it remains stable. If belief weakens, small economic problems can grow into larger ones. Confidence is invisible, but it is one of the strongest forces in finance. This is why reserve currencies last so long, and why they eventually change over decades, not days. Now let's explore different possible futures for the dollar. One possible future is a strong dollar world. This happens if global uncertainty stays high, geopolitical tensions rise, or emerging markets struggle financially. In this case, the dollar remains the preferred safe haven. Another possible future is a slowly weakening dollar world. Inflation, rising debt, and shifting global trade gradually erode its purchasing power. The dollar remains dominant, but less powerful than before. Another possible future is a sideways dollar world. The US faces challenges, but other regions face similar or worse challenges. Forces balance out, and the dollar remains relatively stable without dramatic moves. Another possible future is a transition world. The dollar remains important, but other currencies, gold, or digital systems slowly gain relevance. The dollar doesn't disappear, it just becomes less central over time. History suggests that the most extreme predictions are usually wrong. The dollar is unlikely to collapse suddenly unless an extreme event happens. It is far more likely to adjust gradually. The key lesson from history is simple. Currencies rarely disappear. They lose or gain power slowly. They adapt, and they reflect the world's economic and political balance. The dollar's future is not determined by headlines or social media predictions. It will be shaped by global stability, economic productivity, political trust, innovation, and psychology. The real question is not whether the dollar will survive. The real question is how much influence it will keep and how that influence will change over time.